All righty. Welcome, everyone. Welcome to the Hurley Investments Market View Commentary for Monday, the 14th of October. My name is Kevin Hurley. I'll be with you tonight. I have someone asked me, in fact, I guess my little suggestion is you run into some things, feel free to give me a email. Feel free to bounce some things off me. That's what I do. Someone asked last week, hey, where are you getting this Y Charts weekly market pulse? I'm getting it from Y Charts, but I put the link in. And as I move this over to, the My Hurley investment, I will make sure that the link is there so I can click on it and you can see Y Charts. But pretty interesting last week. The S&P rose by 0.6%, and it was obviously led by the materials and industrial sectors as investors grew more hopeful for a resolution to the trade dispute between U.S. and China. So, out of curiosity, who right now has been invested in materials and industrial stocks? And if you have been, which ones are you in? Okay. I just want to verify that one though before I say anything. Let's go to Deere really quickly. And let's fill it for a year. Before I say anything, because you are tempting me. All right, so yeah, I get it. So the comment was nothing like being in it for a year and not making any money, buying in at 168. So I'm assuming you did a hell of a job catching it at the top and down it went. So yeah, I mean, I don't think Deere has been very good either. Although I was going to say I think Caterpillar has done better. Nope, Caterpillar's done worse. I know FCX has been pretty darn awful. Yeah, I kind yes. The short answer is I also kind of giggled when I was hearing about materials and that they're doing, so good and they're the leaders. And I actually had someone ask me, well, shouldn't we be in more of these type of stocks? And as I look through it, this is what I see. I just don't see the profitability in any material or industrial sectors right now. In fact, if anything, the trade dispute has killed them. Now, we did get a couple bounces, and I think I did tell you last week we're probably going to go higher. I didn't realize, obviously, that we'd get some kind of trade resolution or what have you. But I do want you to spend your time reading the market recap. I think you'll find it very interesting, at least I do. And for all intents and purposes, it's something that could really help out your individual trading or your individual understanding of what's moving in the markets and why. And it just takes a while to sit and listen and or read what's happening here. I was going to go to, well, let me just do it. As I go to Y Charts, it comes in an email. It links me to right here. I get it every Monday morning, I just check my events calendar. I check headline indicators, blah, 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 blah. I like the major fund reviews. That gives me an idea of how I'm doing compared to others. It justifies collar trading for me, for all intents and purposes. I like seeing, and I pay attention, obviously, of year-to-date, week, 1 year growth. And I just review the passive portfolios, making sure that there's something that I'm not missing or I shouldn't be in or what have you. I spent some time in the international funds, fixed income major funds, like seeing those getting their butts handed to them. And most importantly, I spent some time going over the technology major reviews. And again, this is nothing more than me that's just trying to do a little bit of justification on where I'm at and on why. I don't want to miss something. I don't want to, I don't know, I don't want to be too far behind the 8 ball. And I feel sometimes I am. I feel like those that have been in Disney haven't been rewarded yet. I look at financial services, and again, this is my review Monday morning, just to make sure I'm on top of everything. Energy, this is where I sometimes grab some of my stocks and I want to trade. Just my version of seeing what's moving and seeing it in a way that I can justify why we're in what we're in. So where was Target at? Kohl's wasn't in here. Consumer defensive major reviews. It's got to be in all the stocks. But pretty interesting. I enjoy going through it. I suggest maybe you do as well. And just something to give to you guys. So with that said, what I want to go over today is nothing more than how well do you know your stocks? And I'm saying that because I took some flack from a couple people, and a couple people had no clue what was going on in their positions. So we're going to go from September 18th. And I want to bring in a chart, not that one. I want to do Bank of America. And we're going to go at it for 1 month. So September 18th. Here we were fighting 30, and we didn't make it on the 18th. On the 18th of Green Day, we didn't make it. If I brought a little bit more in here, you'll see it was fighting it probably for a week or maybe 2 weeks. So what did I do to our shares of Bank of America? I added the $30 long puts, bought 111 contracts. And protected us till we sold those. Where did I sell those? Group sell. On basically 3 weeks later on the 7th. So taking a look, what did we do? We covered ourselves from the highs of 30 down to 27, maybe 26, bounced up. And I'm pretty sure I probably ended up selling it right there at the close on the low. So what does that mean? What happened if I ended up selling it right here? Can someone tell me what happened to our shares of stock for 2 days? What happened? Someone tell me what happened to those shares of stocks for 2 days? There you go. You had a couple down days. We actually had a down day and an up day. But yes, we had 2 days where the stock, for all intents and purposes, traded 75 cents less, or 3% less than where I sold my long put protection. Yes, we did have a hammer. Yes, we did have a nice day that justified it. But you sold it on a doji. I did, thinking 28 would be our support. Support and resistance levels break all the time. But that is what I did. And yes, I had some people that freaked out. Oh my gosh! What are you doing? We're going without protection. And yeah, we only made 8 cents. I get it. We're going without protection. In fact, on our down day, Kevin, you bought calls. Didn't you screw up? Kevin, what the, quote unquote, right? What the hell are you doing? You're selling calls. I know. I'm actually buying calls. I'm not selling anything. I'm buying calls. But we're down. You took off our protection at 95 cents, sold them for 174. You made us 80 cents, but you took our protection off. And then when it's back down to 27.50, you're buying calls. I know I got a couple WTFs from people, right? What the bleep? It comes back down to knowing your stocks. And yes, I could have been wrong. But I have seen Bank of America do this over and over again. Will someone please type in, what am I doing here? What am I doing that's, I don't want to say that's so wrong because that's not fair. What am I doing? I can give you guys the chart again. There you go. Yes, I'm buying low and selling high. I'll agree with that 100%. In fact, that's probably all I'm doing, right? I'm buying low and I'm selling high. Could things have gone terribly against us? Maybe. I mean, from 30, right? From 30 down to 28.5. We only made what? 5.94 cents maybe. How much did we make? $1.50 down. We only made 95, 174. We made 79 cents on $1.50 down. And then here I go on the next day when it's like, oh, if I just held on to those long puts, right? We could have made more money. But here I am buying calls, a group buy on calls that we paid 104 for. And we got some out at 214 and the bulk of them out at 199. Another dollar profit. And now I've got $29 puts in place. So on the way down 95.74. On the way down, we made 79 cents here. And on the way back up, $1.04 to 199, we made another 95 cents. And at this point in time, it's trading at 29. So from right here on the 18th, our stock is down $1 and we're up $1.84. And we have protection for 29. I can live with that. Our options made up 84 more cents roughly than what our stock did just by watching it go up and down. I'm trying to tell you this because it comes back down to knowing your stocks. And you know what? Someone can pull up a chart and say, but Kevin, couldn't you have been wrong? Definitely. But let me give you one more example of knowing your stocks. I was asked about Wells Fargo, right? Asked about Wells Fargo. Was at 100, down to 35 to 40, back down to 35, and now back up to 100. What do you think? Would Wells Fargo be a screaming deal for you? I mean, this is how I see Wells Fargo. Wasn't quite up to 100, but definitely up to, the 65, 66 range. Would Wells Fargo be a screaming deal for you? I see a couple no's in there, but why? Why would Wells Fargo not be a screaming deal for you, since obviously you're looking at just technicals? Why would Wells Fargo not be a screaming deal for you, since you're looking at just technicals? Because it sucks. That's not technical, but you could say you have a double, if not a triple bottom. That would be positive. Your last cup and handle failed. Down it went. but this could be a longer term cupper handle. You seem to have some support at 47. What are your thoughts? Where's Wells Fargo stand with you guys? Why would you or would you not be invested in Wells Fargo? Good comment. In fact, I think there are two good comments here. It sucks doesn't cut the mustard. But maybe a contrarian, everyone hates it, so maybe a buy. Someone said they're leaving them, and one person said there's more to it, and there is more to it. In fact, it's not a technical decision. You can't use technicals to make this decision. It doesn't validate it. There's no validation on technicals that say, yep, it's a screaming buy, because it's not. There's no technicals there that helps you out. What does help you out is taking a look at the numbers. So I'm going to go to FinViz, and you need something to compare it to. But if I was taking a look at these guys, income not bad, not bad. Book to share value 39, a little above where it's at. Cash per share 91. Hey, it's really cash heavy. Kind of looks good. Their debt to equity kind of sucks. Their earnings next year bites. Good margin, you know, I don't know. Above the 200-day, above the 50-day. You'd have to really find some reasons to maybe not like Wells Fargo. But I think it comes down to management. Not only that, when you take a peek at your upgrade cam from Argus, September 30th. Downgrade by UBS, downgrade by Citi, downgrade by Goldman, Bank of America. I'm skipping all the ones that don't matter. Raymond James, there's another nobody. Deutsche Bank. RBC Capital does matter, but that was January. Citigroup changed it. Edward Jones is no one. Barclays reiterated, overweight. They are kind of someone. Look at the downgrades. Look at what smart money knows. Compare them to something else. Compare them to something that I would prefer to be in, knowing your stocks on a Bank of America. Double top at 31. Ugh, that kind of sucks. Hey, no long term. Let me get that off of there. No debt to equity. And their long term is less than $1. Earnings next year earnings this year is huge. Earnings next year is positive. Book value at 25, cash per share, I like it. Dividend, same thing, 25 to 71, about 3-to-1 income to sales. PE is even less than Wells Fargo. What I don't like is maybe insider owning. Oh, there it is. Sorry, 71 versus 77. I like it. It's good. Significant difference between the two. But Kevin, look, you've got some downgrades too, which is true. Guess what? A downgrade from Keefe, Bruce, and Raymond James. Who cares? BMO Capital Markets is kind of big. Jefferies is big. HSBC is big. UBS is big. Barclays is big. Morgan Stanley is big. RBC is big. Wells Fargo, I mean, I don't know. I don't pay attention to Kiefer and Raymond James. They don't mean anything to me. They're not important. Their ratings aren't important. Pricing 36 to 32. Some pretty good upside opportunity. Looking at Wells Fargo, I don't know if we see that. 51, 54, 56, 58. I just don't see it. I don't see it, so that's why I wouldn't be into Wells Fargo. Not to mention, they just haven't gotten their act together for a lot of the things that they've had issues with. So, knowing your stocks is important. Where our markets end this week, I think we're going to be up based on bank earnings. What's moving bank earnings? Home sales over the quarter. Trading in a sideways market since April. I think that helps. I think we're in good shape because of that. If you look at the Dow, we're still technically bearish, not quite crossed on the MACD. We would have our 5 and 20. We do have our RSI, but still not technically bullish. Same exact thing for the S&P, and roughly the same exact thing on the NASDAQ. Now, are we laying on top of each other right here? We are. But our Williams says we're just about oversold. Excuse me, overbought. We're just about overbought, so I wouldn't plan on seeing things go much higher. Where do I think October will end? We'll be up 1.25%. Earnings, we're hitting our bank earnings. Not much to talk about today. UNH, United Airlines, BlackRock, Schwab, Citigroup, Goldman Sachs, JP Morgan, Johnson & Johnson tomorrow. Abbott, First Horizon National, PNC, US Bank Corp, Alcoa, CXX, IBM, Kinder Morgan, Netflix, Bank of America on Wednesday. Honeywell, an amazing chart on Honeywell. KeyCorp, Morgan Stanley, Philip Morris, Intuitive Surgical, UNP, Snap, Friday, Coke, Schlumberger, and American Express. We're hitting that first big week of bank earnings. Thursday, pretty big day by way of industrial production, capitalization, housing starts, building permits. That'll be a big day. Retail will get criticized on Wednesday for GDP and if the consumer's holding up. Leading indicators and monthly options expiration on Friday. Japan tomorrow has their inflation numbers. More important, on Friday, retail sales, industrial production, GDP year over year and quarter over quarter for China. We do have earnings coming along. I've updated the earnings that I follow for the most part, primarily core earnings or new positions. I've got them all listed in there so that you can follow along. I had some pretty unique articles. Market may be expecting more rate cuts in the Fed will deliver meeting minute show. boy, if they don't do a rate cut at the end of October, markets could really tumble. Markets could tumble, and obviously, it sounds like we're not going to get a true sign deal from China anytime soon. Good read. Make sure you read this when it's posted here later on this evening. Trump says the U.S. come to substantial phase one deal with China. I was more excited about it last week than this week. This week, I think we're just calming the waters, right? Everything I've heard, we're just calming the waters, nothing more. It will help out agricultural, but I do suggest you read through it. Not a whole lot impressed me there, but if you ask Trump, right, it's a great China deal. I hope there's more to it behind the scenes that we just don't know about. Larry Kudlow is one of my favorites. I do appreciate Larry Kudlow. I would expect if the deal is what we think it is, he would have come out with more to say, and he hasn't. So for that reason, I think I'm not too excited about the deal. I was obviously more excited. I was more excited the other day than I am today. That would be the best way to say it. I was more excited last week than I am this week. And it's just because of what's been leaked out. I'm not sure you can believe all of it, but interesting that we didn't see any follow through. Interesting comment, and I'm going to agree with it. I'm probably wrong, but nothing big from China until post-election. I vacillate. And if that was true, Trump is going to stick it to him when he gets elected again. And if I was the Chinese, I might think a little differently along the lines of, hey, we can't risk Trump getting elected again and having him stick it to us, so why don't we create some kind of deal and now see if the new administration will change it. I think that could be a way that it's going, but I wouldn't suspect that that nothing would get done. I think there's still got to move forward, and I think, in all honesty, you'll probably see Trump give some more concessions away. It won't be the deal that he envisioned, but it'll be a deal that he can hang his hat on come election. All right, massive cash shift, blah, 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 blah. Massive cash shift leads hard asset expert to issue a rare prediction. I just think it's important that we watch where big money goes. Now, this is a sales pitch, right? Let's face it. No one's ever really heard of Bill Shaw. If he was really this good, he'd be bought up and making billions of dollars from Morgan Stanley, JP Morgan. Probably may have, called the dot-com crash, the bankruptcy of the real estate, the fall of General Electric, the bankruptcy of Freddie and Fannie, but was obviously nowhere close to a time frame that it mattered. But if you want to buy his crap, I'm sure there are going to be some links that you can buy his crap. But the short answer is, if you follow some of the bigger money, yes, there is a major cash shift going on right now. In fact, it's been going on since the beginning of the year. Can someone tell me what is that shift moving into? Gold, mod, bingo. Gold, silver, platinum, palladium. in all honesty, there's a big shift out of fixed income, out of cash that's gone over to gold. And in all honesty, $1,200 to $1,500, you're looking at about a 25% increase. Yes, it's there. There is a shift. Money is moving from one to another. It's kind of a no-brainer. The question is, am I doing the same? I am not. You'll hear from Kramer, 5 to 10% should be in gold. I'm not interested in just letting something sit. That's not the way I manage money. I'll do my shift where I'll move more into S&P leap long call, long puts if I need to, S&P staggered puts at different levels. But no, I don't use gold or silver as a hedge. Reason why? The start of 2008, gold and silver went down for a while until it took off. But I am looking at having the opportunity for clientele to trade in gold and silver and or stack real gold or silver. Again, not something I'm doing myself. What about gold stocks, or what about the GLD? Yes, if I was going to do something, I could do the GLD, but it would be a whole lot of GLD to get purchased to offset a portfolio. So to be 100% honest with you, I don't see the GLD working like a long put. I just don't see it. I would much rather own a long put. I've seen over and over and over again trying to hedge commodities against equities, against futures. We learned in 2008 all asset classes can drop and crash. Hence, I would stick with a long put. I think a long put works much better than trying to protect or have a certain amount of potential growth in a metal stock to offset losses in your portfolio. That doesn't mean that you can't have some of the position in your portfolio, but it's not something for a doomsday. You know, obviously, if you wanted to stack some silver or gold and have it in case you think you're going to go back to a barter system, that could be useful. But yes, there is a big shift. I think there are better ways for people to have their cash on hand to protect their stock ownership. I found a very interesting article on how someone saved $300,000 by the time they were 26. I enjoyed it. It was an interesting read. Nothing more than that. I think it might be an interesting read for you guys, so I stuck it in here. But pretty amazing to see anyone nowadays take the time to save any money, to be 100% honest with you. But very interesting. Just some things to look at to see how someone else had done. Biggest winners if the U.S. completes this phase deal for stock. I just put them in here. I agree with some. I disagree with others. Nice to see that Apple's in there. I'd probably put Baidu in there. But some really interesting article on who or what has China exposure. Maybe something that you didn't know had so much China exposure could be on this list. So it's nothing more than just giving you a list of some companies with some China exposure so that you know about it. Very interesting article to read there. Vague U.S.-China deal fails to clear the air for companies to start spending and investing again. This mini deal is not making companies want to invest more of their money on the sidelines, which is kind of good, because what does that mean? If you're not going to see a company invest more into some growth, what does that probably mean? Any ideas? More cash on the balance sheet, but that's not what they've been doing. What have they been doing for the last 8 years? Really, since 2010. Bingo. Good call, Lance. Buying more stock. There you go, Mod. Perfect. Dave, bingo. Key, buybacks on stocks. So if there is no China deal, you can, and I would expect, more stocks to be purchased from companies that aren't sure where to invest it, aren't sure where to expand to. Things are on hold because we don't know what the China deal is going to be at yet. So you will see stocks continue to be purchased. And last but not least, I absolutely love it. No, Ken Fisher is not a cookie cutter, put you into a 60-40, 80-20. Well, wait a second, they are that. Never mind. No, Ken Fisher really cares about their investors. Their advisors always talk to them. Well, no, they don't. They just call once a year and send out quarterly statements. Oh, Ken Fisher took the time to let everyone know that he thinks making money is like trying to get a woman in bed. Absolutely disgusting and horrible. Not only is it a lack of judgment, Maud, and a lack of integrity, Dave, it's you are who you are. It's greedy, it's disgusting, and it starts at the top. These guys are my competitors. When it comes down to it, these guys are my competitors. And I'll be honest with you, obviously they've only got, like $1 trillion more than I do. Although they only have like 100 billion in money management. So maybe they only have $1 billion more on their marketing budget than I have. But this is the culture. And at the upper level or the tops of the business, that this is the way you have to act to move up. Again, common sense. Yes, they are a cookie cutter. You're an 80-20, you're a 60-40. They really like pushing you more into bonds because they have a huge amount in bonds and get a huge amount of kickbacks for them. It bothers me. It bothers me that someone that people think are the good guys that care, that still only send out 4 statements a year and call once a year, somehow that is considered good customer service. All right, we got a couple comments here. China has become more suspect than ever with the agreement. Well, yes, they've walked away from it before. I don't think it's a good bet for the near future. Politics has now gone strong into the equation and bring more uncertainty, my 2 cents. There's going to be some type of mini deal. China's going to do that to push everything through the end of the year. We're going to do something like that. So there will be some kind of mini deal, and this clears the road for earnings growth to justify an end of the year 5%, 7% Christmas rally from here. And everything probably will hit the fan next year because once again, we can't muster any true growth on the S&P earnings. And we got some dummy that's predicted 127 and another 19% growth on the S&P 500. That's where our next crash is going to be horrific. Our next market crash is going to be once again because the S&P 500 has had zero growth. And when you have zero growth, you can't justify a 20% return on your market. We are horribly overdue for a real 10% correction or pullback, as they call it, right? Our pullback to being a pullback for a year didn't allow enough time to filter people out. So yes, we have technically had one pullback for one day that was more than 10% intraday, 9.91 or whatever for everything. But because we have risen so high on stock buybacks, on zero real growth on profit on our S&P 500 companies, our next crash very easily could be a halving of the market, a 50% drop. We're long overdue. We haven't had a true bearish correction in over 10 years. We have had our pullback for one day intraday. We juice the market and put band-aids on stuff. So let's face it. There's a lot of garbage out there right now, and there's a lot of payback that's going to come up. Politics is always politics, and if you're trusting politicians, I want to scratch my head on what you're thinking. But I think politics will have very little to do. I think we'll go back to earnings and our typical Christmas rally, Christmas boost to get us through the end of the year. And I think it's going to start sooner than later because I think banks, because of the housing market and because of consumer credit, because the stock market was sideways, which gives them the opportunity to churn things, I think banks will most likely kick off our earnings with us doing pretty well. But any questions you guys have or comments you would like to make? Great comments, by the way. So far today, great comments on everyone. Kevin, but with no China deal, why would you think our markets will continue higher? So I say we're going to not have no China deal. We're going to have a mini deal, which President Trump will definitely look to hype it up. So it's a seasonal occurrence. We go through a Christmas rally. Usually these are not pretty good earnings, but people buy the stocks on the next earnings. We give a lot of companies passes for maybe not the best earnings because of what's going to happen in the next 3 months and the amount of money the U.S. economy throws into the market. That's what I'm betting on. I'm still betting on the U.S. consumer. What would you do with new money right now, knowing that October can be volatile? I would put new money into stock positions. Again, I would play it a little bit longer term. I'm a big fan of Disney. Disney's doing everything right. I think Disney's undervalued and has a good upside opportunity. I like Bank of America. Baidu's horribly undervalued, but I'm not sure I'd put more money into Baidu right now. Facebook has a good opportunity. Visa has a good opportunity. Didn't move quarter over quarter. You can put JP Morgan, Morgan Stanley in there. I might take a peek at American Express. Ford, undervalued. Ford can go from 850 up to 10. There's a 15% return. I think there are a lot of beaten down stocks right now that maybe aren't justified, that you have a pretty good end of the year opportunity. Yes, October can be volatile. In fact, as we learned last year, damn it, November can be volatile. But we do seem to be in a little bit different year. There's some things that are different. So there's a lot of opportunities for new money that's out there. Bill says Ford's been beaten down since it hit 16 several years ago. Agreed. But show me another stock that can go from 850 to 10 overnight on an earnings, which would be, 15%, actually 15, which would be almost be what, an 18% return? What is $1.50 divided by 8? 18.75. Short-term trade. Take Ford from now up to $10 a share. If you get stuck in it, it gives you a 6%, 6.5% dividend. But what an amazing run up to $10. And Bill and I have a bet. So here we go. We'll find $20, $40 gift certificate somewhere where I will make the bet that Ford will hit 10 sooner than it hits 8. I should probably look at where Ford's at, huh? But I'm on it. I'm going to tell you Ford will hit 10, moving $1.50 higher before it hits 8. And it's at 8.52. So you have 52 cents to the downside, and I have $1.48 to the upside. I'll throw $20 on it. Tesla, what do I think of Tesla? I don't think of Tesla. I think Tesla is in the same shape that Netflix is in. Netflix has earnings this week. Netflix can't grow enough to be impressive, and it's poorly run. So I don't think about Netflix. I think it's a broken company, broken management, definitely broken fundamentals. Truly can't run a profit, and they can't run a profit because of how much debt that they owe. So, well, they were profitable for a quarter. I'm like, yeah, not really. They just fudged their numbers and increased the cash and, rearrange things. So if you're going to play Tesla, understand it's a 100% pure gamble. It's not necessarily a position to play for stock ownership. I read Tesla batteries cost in the $30K range when they have to be changed. Not a good scenario. Agreed. In fact, they do have some unique battery technology, but I've got two neighbors that bought Teslas and got rid of them after 8 months and maybe a year and a half, because no one wants to be limited to really 180 to 220 miles. Yeah, but you can get 300 or 400. Well, yeah, if you drive like a grandma, but when you go from 0 to 60 in 3 seconds, most people don't drive like a grandma. And we like to play our radio, and we like to plug in our phones, and it sucks to go 180 to 220 miles and have to charge. It would be a lot better when the batteries can truly go 400 to 500 miles. Then you're looking at an interesting opportunity. When you run your lights and so forth, nothing like only going 156 miles, and it's a fad. So Tesla is not where I would be putting my money at. I'd go Ford. Any other questions I can answer for you guys? What do I think of Apple? Wow. I like the move. I can see where justified they can go higher. They've broken out to the upside, but I would be more willing to protect Apple at 332 and a half, 335, and I don't see that Apple will get the love of an earnings report. Another comment was made to me, in an article that came out this morning, Apple's going to really knock it out of the park next year with a cheaper phone for $399. Keeve and I sat down on our Monday morning meetings, and Keeve says, so what do you think? And I kind of giggled, and I thought, what a load of crap. Why would anyone write that article, and why would anyone believe that article? Is that Apple's MO to go to the cheap side? Could you see Apple deciding to make a cheaper computer so they can sell a computer cheaper for more sales? I don't see it. With all due respect, Apple doing a $399 phone to completely erode their profit margin and to knock it down to levels where everyone and their uncle can just tear them apart, I don't see it. It's a pie in the sky dream. All of a sudden, Apple's going to change their culture and say, you know what? We're going to go cheap. So we can get a cheaper iWatch and a cheap computer. Forget trying to get people for $1,800 to $2,400. Let's go cheap. I don't know why anyone would believe an article from someone that thinks Apple's going to go cheap. It just doesn't make sense. Doesn't fit the norm, doesn't fit the status quo for Apple. So if that's what you're talking about, that's my 2 cents. I don't see it. I don't see Apple going cheap and going to pick up all these sales in 2020 because they offer a cheap iPhone. Not going to happen. Dumb article. People should know better. And yes, I'll eat crow if they go cheap, but I don't see it. Any other questions? These are good questions today, guys. Going a little long. We're here a full hour. But are there any other questions I can answer for you? And obviously, if I did not answer a question or you don't want it read out loud, you're always welcome to email me. khurley@hurleyinvestments.com. Feel free to get a hold of me. I post all these on myhurleyinvestment.com. Get to me at customer service or support at hurleyinvestment.com. So a lot of places to reach me if you need to. Guys, have a good night. Pleasure being with you. Appreciate you attending, and until next week, talk to you then. Bye-bye.